Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This is all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so well over a full year now, has been, though I'm now starting to look at another pattern, wasn't this despite being breached and repaired only as recently as early October, is the dark blue September to December 2024 bear channel, currently 1062 to 1532, that has developed into a descending expanding wedge pattern. The mauve medium moving average currently at 1563, and in recent times, especially the last 2 weeks, the nearer green short medium moving average currently at 1518 has also helped cap the market on occasions. Both today are paralleling either side of the dark blue upper trend line. There are two other patterns that have great influence this market. The first, and the one I think may be trying to take over as the main pattern here, is the bright green late September 24 to late February 25 bearish shift pitchfork. I drew the original Andrews pitchfork, bearish Andrews pitchfork, for this move some 37 weeks ago, as it seemed back then to be a better contender, showing the bearish angle of attack. But that did not last, and I finessed it to what we have now, the shallower bearish shift pitchfork, for the same move. Today we are just underneath the overhead bright green middle time, which is currently at 1544, having tested it late 2 weeks ago and rejected the move up. The second pattern is another larger bearish pattern, which I had also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 24, similar but slightly shallower bearish shift pitchfork. On this one we're just above the bright red middle time, which is currently at 1439. We also have the March 21 low in there at 1466. Now 6 weeks ago we had a break below the bright red middle time, pushing down below the previous significant low in late June at 1468, down to a new low, one that has not been seen since December 2020. Indeed, we dipped down to that December 2020 low at 1409 for around 3 weeks. However, each time this was tested, prices backed off higher from this low because, as I said 6 weeks ago, and I quote, "We next have support on the downside on congestion based around the significant 61.8% for absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle time. Well, we had that stabilization and nothing much happened, so the market started to move back up over the bright red middle time, but was it's constrained in its height by the bright green middle time above, effectively being forced to channel lower. Looking further down, we have support, including the significant 21st century 61.8% absolute Fibonacci line at 1383, and that supports between 1379 to 1409. That's that same 1409 level we spoke about earlier in November. And then, well, we really don't have that much support until around the 1248 level. I'm not too confident about this supposed support down there as well. We also have a gap between 1336 down to 1320, dating from September 2020. So a lot has depended on that congestion support between 1379 to 1409. On top of all that, October was a monthly key reversal down, a bearish factor. Though, as I said last week, and I quote, I can't help thinking, that maybe such a pattern could be seen as a swan song. However, until otherwise, the pressure is still on the downside. End of quote. While the pressure is still on the downside, though we seem to have undergone the small mild retracement on the upside that's hit some solid resistance overhead, and that may be enough for now. However, as I said last week, and I quote, I can't help feeling that this market is going to get squeezed and maybe squeezed lower. Ice Europe, white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. The first of the three features is the obvious: broken, repaired, broken again, repaired and lately breached if not broken. Purple late September 2024 to mid-February 25 descending expanding wedge pattern. And that's currently at 428.40 down to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary, but it was made back in January this year. Had earlier been severely tested on the top side, enough that I would not necessarily classify as a descending wedge pattern after February, though I continue to still keep an eye on the extension to the purple upper trend line, as it is, bar some congestion at 425.5, the nearest support and resistance of this market. Next, I also asked you 32 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitch hawk. This is a very shallow pitch hawk. The more market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market initially started utilizing the bright pink middle tine of the bearish shift pitch hawk, currently at 453.10, as an attractor, riding prices down lower in a shallow glide until early October, when it started a further, steeper journey lower, such that in early November the market had been closer to the pink lower tine, which is currently at 394.70. However, we have seen a pull upwards since mid-November that has only been capped over the last 2 weeks by in part the purple upper trend line which I previously mentioned, but especially by the declining green short medium moving average, currently at 433.60. The third feature, which developed since the beginning of September and late 4 weeks ago, saw prices break above it, and is the early September to late November bear channel. This bear channel had been excellent at showing the summer into autumn bearishness of the market, including 4 weeks ago the lowest low since December 2020. However, that same week prices broke up and out of the pattern and late 3 weeks ago stabilized over it, such that 2 weeks ago I laid out possible targets for this pattern on the top side. We have a primary target X up in the 447.40 area and a secondary harder to achieve target X1 up in the 454 even area. Now I'm still not too sure about these two targets, as the green short medium moving average had been very effective in seemingly batting prices back down, but for now they stand. Now one final feature to note is how the mauve medium moving average, currently at 453.40, which had tracked along parallel to the bright pink upper tine since last year, well, this week it is dipping below it. Now this has happened before, but it is worth pointing out nevertheless, as I think it will become more relevant in the coming weeks. Sugar white premium. This chart has been a disappointing one, not because of the market doing the opposite of what I thought the patterns might indicate, but because the market has instead done nothing, or at least nothing much. 12 weeks ago, I said here, and I quote, things seem to be trying to resolve themselves into a pattern, end of quote. And over the intervening weeks, they seem to be doing just that, though not always in the way I imagined they would, or even to a clear resolution. You see, I thought we might be moving towards, as I cautioned for a number of months, and again I quote, I have a fear, and this is a real fear, that the whole February 25 today action may be trying to form a possible diamond pattern, end of quote. Now I continued, and I once again quote, this would be a large pattern in time, probably from February through to November this year, and in height roughly between just under 100 up to 150. It's too early to say if this is happening, but I would urge you to keep an eye on such a possibility. And that's the end of the quote. That possibility looked real until 12 weeks ago, when the market dropped down and below what I thought might be the lower bullish trend line, highlighted in dark blue. The market not only dropped below this trend line, and let's be honest, it is an unjustified trend line, but went further to drop and close below the gold long moving average, currently 107.25. Stabilizing further down, dropping and closing below a new support line, which is the bright red neckline, and it's currently at 97.75 of a new simpler pattern, which the market opted to utilize instead of the more complex diamond pattern. It became a February to early October head and shoulders top. Dump, dump. The issue I had and still have with this pattern is that we are now past the early stages, and we really haven't confirmed a single move higher above the gold long moving average, or lower below the bright red neckline extension. I chose 8 weeks ago to lay out some potentials below for such a head and shoulders top pattern, just in case. Thus, a primary target X is down in the 70 even zone, with a secondary harder to reach target X1 down at 43 3/4. You'll easily note that primary target X is at the lower end of the congestion seen between September to January 2025, between approximately September 24 to January 25, between approximately 70 even up to 85 even. Since then, nothing, or at least nothing much has occurred. We even had a weekly key reversal up 4 weeks ago, which failed to follow through and instead ended up with a combination of a hammer pattern, usually seen as a bullish pattern, though not always, and also a week 2 in a 2-week descending hawk pattern, which is a bearish pattern. And then last week we had a weekly hanging man pattern, a pattern that is traditionally seen as a bearish reversal pattern, but which data indicates is a bullish continuation pattern. Some 6 out of 10 times, that's how many times it is a bullish continuation pattern. And that's thus contradicting patterns that are coming up. It all still comes down to what I said 8 weeks ago, and I quote, "Only concerted, consistent, and long-term moves over the new bright red neckline, and ideally over the slowly rising long-moving average, could possibly assuage the bearish pressure potential, at least as far down as the 70 even to 85 even congestion." That's the end of the quotes. We had been half there and half not there, and the last 4 weeks' moves just exemplifies these half in and half out contradictory course of actions. It is indecision, but on a much, much larger scale, more than just a weekly chart. You can really show how it's done. It's much more than that.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.